Hello, everyone. My name is Matthew Frailey, founder of BreakpointTrades.com. I founded it back in 2003, 20 years ago, to provide advanced technical analysis, market commentary, trade ideas, and mechanical trading algorithms, like you see here with our 21 SPY NES mean reversion systems with about 90% winning trades. And of course, most recently, our KISS trend following systems, which are just absolutely fantastic. Never seen anything like it in my 25 years of doing this. You should really check them out. I'll do a much more detailed video on that eventually. And anyway, let's get back to this weekend's market newsletter. So, this is my comprehensive weekend newsletter on the markets and, of course, our trading systems. And this is going to be for January 14th to the 17th. And the reason why is because, as we've been stating, administration note, both Steve and I will be out of town. We'll be gone from Monday until Wednesday evening. We're both traveling to New York. We're meeting with a company we have a pretty good sizable investment in. Could always talk to you about that another time. But we'll actually both be gone, so there's not going to be a newsletter on Tuesday or Wednesday. That's the first time, I think, in 20 years that both Steve and I have been out of town at the same time. Okay, so it's extremely, extremely rare. You guys will be fine. Plus, as you know, Monday, the market is closed for Martin Luther King. So really, we're only gone 2 trading days. Again, you guys should be fine when we're in our absence. And of course, James Rowe, our technician or our technical person behind the scenes, he's here. He'll be updating our KISS systems, emailing those signals out. Okay, again, first off, I hope everyone had a nice weekend. I hope you stayed warm. It's extremely cold across the U.S., pretty much from the West Coast to the East Coast. For us here in Southern Illinois, it got down to -7 degrees this morning. That's regular temperature. That's not wind chill. I think wind chill was like -30. And it's colder in a lot of other places. We got a little bit of snow, but other places got quite a bit of snow, and it's cold. So again, pretty cold. Hope you guys all staying warm. So again, hope you had a nice weekend. This weekend newsletter, and especially if you're new to Breakpoint trades, they tend to be quite comprehensive. Usually about 40-45 minutes or so. We cover a lot of things. You can see from the table of contents. I have my open discussion. Here I'm going to discuss our systems, our mean reversion, and our KISS trend systems. Going to go over some detailed examples there. We'll then follow up with the general market analysis with the major indexes. We look at the S&P, the Dow, the NASDAQ, Russell 2000, and we do a top-down approach from the large time frame to the smaller time frames. Then we look at our custom indicators, such as the VIX, NAMO, NIMO, etc. We'll also look at bonds and interest rates. We're going to look at a few market sectors. Usually on the weekend, we cover all the sectors. We follow 21 of them, by the way. But just to keep the number of charts down, I'm just going to cover a few of them only. Then we'll move on to the US dollar, currencies, commodities, Bitcoin, precious metals. I'll cover a couple trade ideas we had last couple weeks. I'm not offering any new ones here because we're going to be out of town. The market's closed on Monday for the holiday. So anyway, as you can see, just keep going to discuss the general market. So last week, the major indexes posted gains, save for the Russell 2000, which closed flat. The S&P gained about 1.84%. NASDAQ, big tech, gained 3.2%. And out of the 21 market sectors we follow, however, even though most of the indexes were up nicely, only 10 of them, about half of them were up. So the gains last week were primarily concentrated in that tech area. Okay, those are the strongest sectors last week: technology, semiconductors. The weakest sectors were energy stocks and banks. Again, as far as the general market, as you know, we were looking for a pullback from late December, and we got it in the first week of January. The first 4 days into January. Our mean reversion systems caught that pullback, then exited the rally for very nice gains. The S&P and Dow and almost the Qs are back to the highs. Now, like I said, the trend is up, guys. No doubt about it. It's been crazy up, strong since the late October lows. By the way, that's when our KISS systems went long. But a couple things that are a little cause for concern. They don't mean you go out there and short, but definitely some flashing yellow lights here, maybe an area to add some hedges. So The VBIX, that's the volatility of the VIX. We cover both of them. Was trading below its lower Bollinger Bands last week. It closed back above them on Friday. That's actually a S&P sell signal. Also, we have negative divergence that continue to form on the percentage of stocks in the S&P 500 above their 20-day moving averages, as well as the NYAD advanced decline, and both the NAMO and NIMO. Okay. Also, so those are a few things to realize. For bonds and interest rates, as you know, I called for a intermediate bottom in the 10-year back in October when it was 5%, and that ended up being a great call. In December, mid-December, I said interest rates look very oversold, looked like they were going to rally, and they have. They're starting to pull back as of last week. I am looking for a higher low there. And again, as far as the markets, for a better pullback, we need a catalyst. When one's catalyst you still have to be aware of could be geopolitical, Middle East, if that escalates. Also, cryptocurrencies last week, SEC approved some rule changes to pave the way for Bitcoin ETFs. But that said, it ended up being an absolute textbook buy the rumor, sell the news. I hope none of you got caught into that. It was just obvious. We talked about it. All those areas rallied up into the news, and then once the news came, crypto started selling off, and especially the stocks like Mara, MSTR, Riot got absolutely hammered. Here's the key news items for the week. Okay, enough about that. Let's go ahead and move on. Item number 2 shows the index sector table, what transpired last week and on Friday. Again, Friday was kind of a bifurcation day with the Dow and Russell down. The other indexes only slightly up. And like I said, the major indexes, everything was up nicely except for the Russell. And as I also stated, out of the 21 market sectors we follow, only 10 of them closed up for the week. So it wasn't that broad of a rally. It was mainly concentrated in the tech area, technology and semiconductors. Currencies were up about US dollar was up 0.15% for the week. Bitcoin, which had been trading up nicely, we had that sell the news event last week, so it was weak the last couple of days. Especially the stocks though got absolutely smoked. And commodities, kind of a mixed bag here. Now natural gas had a huge week. Not surprised, guys. That moves with the weather, and we have this extremely cold weather, so natural gas had a huge rally, up 14.5% for the week. Huge week. Otherwise, the index itself was down. A lot of that was primarily to crude oil, down 1.5%. Some weakness here in the ags, corn and wheat, down over 3%. Precious metals, gold ended up just slightly positive. GDX, the miners, ended up slightly negative. And as far as the bonds and rates, the 10-year had a nice pullback last week. Again, I am looking for a higher low there. Next, item number 3 shows the economic news calendar, which again I already showed in the opening slide on my table of contents. But again, markets closed on Monday. No news really. On the 17th, retail sales, export, import data, business inventories, NAHB housing, Fed beige book. On the 18th, that's your initial jobless claims. Philly Fed, natural gas, crude oil inventories, and Friday, existing home sales, Michigan sentiment. Next, let's talk about the mechanical trading systems. So again, I already discussed these last week, but in case you're new, so this image shows you the mean reversion systems that triggered during that pullback we had from basically the last day of December until the first 4 trading days of January. Our mean reversion systems were flat from that move up from the late October lows until the late December highs because we hardly had any pullback. Remember, there was really no volatility. Mean reversion systems, the longs, they're looking to buy pullbacks and uptrends, and we just didn't have enough of a pullback for those to trigger. They finally did trigger in early January, as you can see here. They all made nice winning trades. Again, there's 21 mean reversion systems. 3 of them triggered. There was a long trend Momo, and there's another one too. I don't have it on here, but anyway, we run them across both ES Futures and SPY. We send out trade notifications to our subscribers. These were very nice winning trades. They're all in cash now, but you can see the nice gains here. On the MES side, that's micro ES, so it's only 1/10 of ES futures. Nice gains there of about $3,000 if you did those trades. And even on the SPY ETF, you got about $750 on 20,000. That's not bad. Easily pays for your membership for years. And a good example of the mean reversion systems. They're high probability. They don't look to hold for long-term trends. They look for a statistical opportunity. And they get in, they get out, and they wait in cash for the majority of the time. That's how these work. Okay, kind of similar to a Larry Connor's RSI2 type system, but that's one mean reversion system. We have 21 of them. Next, let's talk about my favorite thing, our KISS systems, which have been just absolutely knocking it out of the park, guys. But we're really expanding on this year. And I've been doing this stuff, guys. Started looking at charts back in the late 90s, 1997, I think, when I got my first job out of college. And I've never seen anything this powerful. I've dealt with, millions of charts over the years. I've dealt with so many mechanical trading systems from myself to, dozens and dozens, maybe hundreds from other people. I've never seen anything like these that impressed me so much. But anyway, so what the KISS system is, it's long only, first off. It has a lot of different rules that it looks to go long. It then sets an initial stop, a smart trailing stop. It moves that stop over time to give you protection. It's kind of like, I know it's corny to say life insurance for your portfolio. If you just buy and hold, then you're subject to sharp corrections, bear markets that you have to sit through. And I know your financial advisor would tell you, just stay the course, hold for the long term. It always goes back up, and that's true. If you hold long enough, you'll always recover those bear markets, but you lose a lot of time. You lose headache, there's emotion. It sucks to go through 30% corrections and hold through it. So the beauty of the KISS systems is they can ride an uptrend, protect your profits, and keep you out of those big sell-offs. So here's an example of the KISS system on the S&P 500. This is late 2019, 2020. As you know, the S&P 500 had about a 30% correction in a month. Obviously, it recovered, but that's a hell of a correction during that COVID lockdown. The Qs had almost a 35% drawdown. So the KISS system was long coming into that. It had a stop at 32.89 on the S&P, so it would have got you out way up here back in February. You would have avoided that 30% correction. Again, you didn't get off at the highs, but maybe 4% off the highs. So you avoided, a good 28, 29% of that sell-off. Then it got you back in at the lows, one bar off the bottom, put an initial stop at the low there, and then raised it up over time. You can see it had held it until June of 2020, got out, which was just being a little sideways consolidation correction, and then got back in, rode it again, got out, and I don't show it on here, but that's what it does. It rides the uptrends. It prevents you from going through big drawdowns. It's able to capture at least the gains on the S&P 500 or instrument that it's following with 1/5 to 1/10 of the drawdown. It's almost holy grail type stuff. Next, here's an example of the current S&P. Again, I'll be showing this later, but you can see what it's done last year and this year. Last year it was long during much of that year into early August. Had a little whipsaw trade there in the fall, got out with its stop. It got back in late October, and it's been up since. And you can see the current smart trailing stop. You can see how many times it's raised it. It went long there in October, put an initial stop at 4,100, raised it up over time. Current stop is 46.84. So if the market decides to have a nice correction here for a month or two, it'll have you nicely protected. If the market just wants to keep rallying, it'll stay with the trend. That's the beauty of it. Next, image number 7. So again, where do you find the KISS systems? So you go to the website, go to the systems area. The mean reversion systems are at the top. The KISS STS tables are here. I'm probably going to reorganize this a little bit when I get back, but go to there and you'll come to this section. We follow over 630 stocks and ETFs that we run daily with the KISS system. You can go here. We got a basket. We have the Mega 10 cap tech stocks, S&P 500 stocks, all the Dow 30 stocks, all the top ETFs, over 100 of them, and you can set favorites. But so you can see here on the basket, this highlighted, Google had a new smart trailing stop that was generated on Friday. It's the second, so it just went long here in December 28th. Trade is up 2.16%, not very much. Here's your current stop, 135.40. That was the previous stop. Currently, price is about 5% away from the smart trailing stop. Okay. Whenever you set favorites on the KISS section, you'll automatically get email notifications to your favorites. Again, you set your favorites by clicking the star, but you'll get an email whenever your favorites have a new entry, whenever there's a new smart trailing stop, whenever they exit. So 100% mechanical. You can just follow, and you can click on the symbols to see the charts. Okay, but you can see the nice gains here on the BPT basket. Here, Bido's up. That's a Bitcoin type thing, up almost 40%. Dow's up 10.3%. Amazon, no, ABGO up 16%. AMD up 30.6%. It went long on January 2nd. Crazy that it's up that much just with that entry. And the Q's up 16.5% from its December or October 31st entry. Image number 8. Here's just some other tables. Here's the top 100 ETFs for the KISS system. And again, just some monster gains here, especially some of these leveraged ETFs. Look at these. Well, first off, UNG, the natural gas ETF, had a new smart trailing stop generated on Friday. The fourth one, the trade is up 24.5%. Now, the smart trailing stop is, right now, it's quite far away, 16.4% away from the smart trailing stop. So it is a little vulnerable there for some pullback soon. But again, the trade's up nicely. But look at some of these gains here. Now, again, some of these are leveraged, but LABU up 78%, GBTC 76%, just massive gains. Again, if you've been following the KISS systems, you could have been alerted to these. These were all been real-time signals. We launched these back in the summer, so these have been live since then. Next. Number 9, here's the 10 of the big cap tech stocks that basically rule the market, and you can see what they've been doing. Currently Apple and Tesla, the system is flat. It's not in them. You can see I have Apple as a favorite. You can see the other ones, what they're up. They're up nicely. Next. Showing you what the KISS systems also look like. Here's GBTC from the KISS systems table. So whenever you click on it, you can actually get a live chart here. KISS on GBTC, it went long on October 16th, right here. Put an initial smart trailing stop there at 1930. You can see how it raised it all that time. Current one is up here around 35. It's up. The current trade is up 76.5%. Next. One thing we're excited about is our high performance KISS systems that I hope to be launching sometime after I get back. So here's some example of these. Here's the Qs, and here's SSO, that's the S&P 500 ETF, compared to buy and hold, okay, where you just go long and you hold it like your financial advisor would do. So here's the Qs 65-minute KISS system. Again, these will be eventually available on the website. But again, here's the beauty of the KISS system, guys. If you look here, the percentage gains compared to buy and hold, it matches or beats most years. But look at the drawdowns. Max drawdown, average of 4%. The max drawdown average is 28% on buy and hold. So 7-fold less drawdown. Here's the number of trades per year. That's not many trades. Average of 6 trades a year. You can work a busy day job and do that. And again, primarily where this beats the market is in bear markets. 2022, the KISS system for here would have lost 1.3%. Buy and hold would have lost 32.5%. Quite the difference. And look at the drawdown difference. 2008, this would have made 3.5%. Not much, but it still eked out a gain. Buy and hold, you lost almost 42% with 50% drawdowns. Okay. But again, a lot of years beat. Here's 2020 up 76% versus 48% on buy and hold. Last year, KISS did a little less than buy and hold, but it wasn't much less. And again, part of that may be a trade held from 2022 to 23 that's not being shown here, or from 2023 to 2024. But pretty amazing stuff. You can see the average time in trade, 61 days. $10,000 turns into $618,000 versus $10,000 turning into about $196,000 on buy and hold. Here's SSO, a leveraged ETF, and even more impressive because of the leveraged ETF. Look at these gains. Even in 2022, it made 32% versus S&P losing 38%, or SSO. That's quite the damn difference. $10,000 turns into $2 million versus $69,000 for buy and hold. So that's an example of some of the statistics for these KISS systems. Very excited about these. But again, KISS systems, like I said, they're long only, but they're able to capture the gains of buy and hold, or 2 or 3 times more, with 1/7 to 1/10 drawdown. KISS systems are also, the other thing I was thinking about, they're kind of like an indexed annuity on steroids. So what indexed annuities are is they're these things that instruments have gotten quite popular. Now, I had trouble finding some recent stats on some of these, so that's why this only goes to 2015. A lot of these companies are, when you do a Google search, it's all advertisements and they want someone to call you. But what indexed annuity does is they dupe people into investing into them. Basically during market years where the market is down, you don't lose any money. You're flat. And when the market is up, you make some money, but it's capped. Okay, so you don't make what the market makes. So, for example, here, 2002, the S&P 500 lost 23%, but the indexed annuity, you was zero. You don't take any losses during the down years. 2008, same thing. But your gains are capped. 2009, S&P gained 23.5%. The annuity gained 3.46%. You see what I mean? 2013, S&P gained 29.6%. The annuity gained 13.9%. So you give up huge potential gains. Okay, you gave up all those. The KISS system is similar in the bear market years, where you're either not taking a loss or you're actually making money, but you're making more money during the other years. You're not giving that up. And the other problem with indexed annuities, they lock your money up for 8 to 10 years. If you take it out, you have a big 5 or 10% penalty. So not a fan of them. That's why I like the KISS systems. Okay, guys, enough of that. Let's go ahead and move back to the general market newsletter. So image number 13, here's a weekly view of the major indexes. So again, they were up last week, except for the Russell. You can see we had that pullback into early January like we thought. Then we're getting another rally. S&P testing its all-time highs. And you can see the NASDAQ bounced off its 9-week EMA. Nice rally out of those consolidation channel flag patterns, of course, back in October through the end of the year. Next. Chart number 14, here's a monthly chart of the major indexes. Each chart's a month. Again, as you know, 2022 was the bear market. Big rally last year usually occurs after a bear market. We bounced off this long-term uptrend lines. We're now back at the upper Bollinger Bands on these monthly charts. On the IWM at the bottom here, it bounced off this long-term support area. That 160 area has been major, important, going all the way back to 2018, as you can see. And finally, chart number 15, here's the daily view of the indexes with the Bollinger Bands. One thing I want to point out here, Bollinger Bands are starting to pinch in all these. You see that? That's important because a bigger move, volatility is likely to pick up here. I think we're due for a correction here, and it's also possible we could see a little quick pop up and then a drop. Okay, But I'm on look for a correction here because of some of the divergences with these indicators, which I'll cover later. Next, chart number 16, here's the Dow Jones daily. Again, basically a moonshot up from that October lows, never losing that 9 EMA all the way. I said watch for a bounce off that 20-day moving average, which we did, rallied up, and we tested the highs again last week, pulling back. Again, there's some RSI divergence, MACD divergence. The trend is up, but this is vulnerable, especially with this wide moving average ribbon, for a pullback. If we lose that 20-day moving average, that could set the stage for a pullback all the way down to the 50. Next, another reason I'm cautious is some of these inverse ETFs, such as the SDOW, that's the 3-time leveraged ETF for the Dow. This has a really nice base forming, nice base, good volume patterns. You know, long trigger would be just over 1911, and you might get a nice move up to the 50-day moving average. This could be a good hedge, something to watch coming this week on Tuesday. And chart number 18, here's a 2-hour view. What you see here is this really nice base that is forming. Again, I'm long a little bit now. I got to stop just below the lower channel, but if it breaks this channel, you could also go long, add to your position. So that's what I'm watching. That's what I'd be watching early this week. Again, Steve and I won't be here on Tuesday and Wednesday, unfortunately. Next, chart number 19. Here's the S&P 500 daily and or the weekly. So again, the S&P gained 1.84% for the week. Pulled back, didn't quite tag that 9 EMA. It's trying to target the all-time highs. Should we push up further here? Again, to me, that's an easy target. It's a magnet. Think about when you put two magnets very close together. You get too close, you can't hold them and they'll snap together. That's the way I view these when you get to these near these major areas. You get too close of them, gravity or magnetism will just pull them together. So I wouldn't be surprised if we do tag that. But ultimately, I do think we'll test this bigger support area on a pullback when we do get it. Chart number 20, here's the daily view of the S&P. Again, we had that pullback from late December into early January. We've rallied back up here. But anyway, keep an eye on it, guys. We are making a brief high, but this could set up some pretty good divergence. Next, chart number 21, here's a zoomed out view of the daily. Next, chart number 22, here's another daily. Again, we're back to those highs. This area, by the way, is a thin zone. This is the price by volume indicators. You can see the big volume bars. So that's where you got the smallest volume. So if the S&P does pull back, it comes down to this area. It's likely to at least fill this thin zone because, again, very little support there. Your big support's down around in here where you see the bigger volume patterns. Chart number 23, here's the current KISS trend system, which I already showed you. But again, current stop is 46.84, so nicely protected. I love how it went long near the lows, raised its stop all the time. It's a great example of the KISS system in action on the S&P. The 60 stochastic is still embedded over 80%. That's something to watch as well. The moving average ribbon has been a good guide. Whenever it's uptrending and turned to red, those are good areas to look for longs, just like here recently when it was pinching into the moving averages. And near the ATR was a good area to go long. Chart number 24. So this shows you the weekly KISS systems, and I meant to have this above, of the major indexes. So again, on the weekly KISS versions, the smart trailing stops are obviously going to be a lot wider than the daily, right? But you know, you can see looks like this image is cut off. I apologize for that, guys, on the cues here. The weekly KISS is 44.30. IWM, it's down here at 175. You can see where they went long. They avoided the 2022 bear markets nicely. And again, we have weekly versions, but my main focus is on the daily and shorter time frames, quite honestly. Next, chart number 25. Here's the 4 time frames on the S&P with our custom indicator. So here's the daily. So at the end of December, we had all those A's. That's amateur buying. Tends to occur near highs and lows. That obviously produced a little pullback in the market. We bounced off the ATR. Moving average ribbon still bullishly stacked. We had a DeMark 9. Also, after that pullback, we bounced from there and the support cycle. Now, we do have an end of bull cycle here in the half day, so we want to watch that, see if price stalls there or breaks through it. Next, chart 26. Here's the half day chart. Again, we had that little wedge that we were showing back in late December, which did produce a little pullback. Again, it was only to the 50-day moving average. Our mean reversion systems bought that, and we've rallied back to the highs. That said, look at the MACD here. Making a new high here, guys, this MACD is really lagging price. So it's going to set up a bigger divergence if we make more of a high. That's why I'm cautious. Chart 27, here's the 30-minute chart. Again, if you weren't long, your long signal was going long last Monday when you broke through these channels. Pro tip, guys, whenever you have a downtrend, pronounced downtrend where you have a clean downtrend line, whenever you break that, that's often a breakaway gap. You can go long that with a tight stop. That was your signal, and you can see otherwise we continue to uptrend. Next, chart 28. Here's the 30-minute chart I've been showing. Early last week, I was showing this while price was still in this channel. I mentioned this was the support area where we bounced off of. So right now, you got a little support uptrend line here, resistance at the highs. Chart 29, here's a 15-minute chart showing the rally out of the pattern and the current uptrend line. Again, nothing, I don't see anything really negative here at the moment, but you know, should the market go to the new highs, remember we will still have divergence building. Next, moving on to the NASDAQ. Here's chart 30, the NASDAQ daily. They're lagging behind the S&P a bit. They retraced a lot, but they still haven't retraced back to the highs yet. And again, if this makes a new high, you're going to have a pretty good MACD divergence here. It's really lagging relative to that recent high. Chart 31, here's the daily KISS. Daily KISS on system for the triple Qs. Current stop, smart trailing stop is still 394.60. Prices bounced back and slightly above that ATR now, so it's recovered the ATR, which is a slight positive there. Again, the system is long. It went long in late or early October. Excellent entry. Chart 32, here's the 4 time frames. Again, similar to the daily, similar to the S&P, had those A's at the top. On the half day, you had the DeMark 9 support cycle. Now in this rally, you have a DeMark 9 as well. On the 130-minute, you have a resistance cycle. ATR is support on all these time frames now. Chart 33, here's the triple Qs half-day chart. This shows symmetry. Because this was the largest pullback in the uptrend from the October lows, roughly 17.5 points, there is still some odds at a lower high here, so something to be aware of. Chart 34, here's triple Qs 30-minute chart. Again, looks similar to the S&P. It still looks fine here to me, honestly. Higher highs, higher lows could be kind of flagging here. But again, we'll see obviously what it does this week. Chart 35, here's the Russell 2000. Now this is the monthly chart. So far it's down for the month. Again, rallied perfectly off that 160 support. You can see that 160 area has been important support resistance going back to 2018. This is your current resistance up here around 205.50 where it pulled back from. Chart 36, here's the daily. Again, hell of a rally from that inverse head and shoulder pattern off that demand zone we were showing back in October. Pretty much a straight up move. Got very extended. Look at the divergence on the RSI. Quick sell-off. And quite honestly, it still looks weak here, guys, kind of forming a bear flag. Wouldn't be surprised if this falls down to its 50-day moving average. And the final chart here, chart 37, here's IWM 60-minute. I didn't adjust this chart. It's a little messy. But again, you can see overall it's still downtrending. It still looks quite weak. All right. That does it for the major indexes. Now let's go ahead and look at some of our custom indicators. So chart 38, here's the VIX Bollinger Band system. So you get your buy and sell signals whenever it's outside its Bollinger Bands and closes back inside. We had a VIX Bollinger Band buy signal there in December and one here in January after that pullback, and that was a nice signal. Both of those were. So right now it's not really saying much, but the VVIX is interesting. Let's look at that. Chapter 39, here's the VVIX. That's the volatility of the VIX. Now, most of the time these give the same signals, but sometimes they're a day difference. Sometimes the VVIX will give you an early signal. So this was trading below its lower Bollinger Bands last week. It closed back inside, had a big up day on Friday. So that is actually a S&P 500 sell signal generated right there. So we'll see if that plays out or not. You can see the previous buy and sell signals. Pretty good signals. Not all of them are perfect, such as this little sell signal. Last June only produced a little sideways pullback. But a lot of these, this was a great buy signal. That was a good buy signal. That was a good sell signal. That was a good buy signal. You know, you do have a sell signal here. Chart 40, here's another chart of this VIX with the S&P 500. Basically the same chart, but here's your rules, and you can see the signals. This is a little cleaner chart than the previous one. Next, let's take a look at some of these problem indicators. So here's the percentage of stocks in the S&P 500 that are trading above their 20-day moving average. So at the December highs, you had a big divergence here. And again, that relative to the S&P, and that played out for a pullback, didn't it, in the market? You can see the previous times you've had divergences. Last July, that produced a nice market pullback. You had a positive divergence there in October. That produced a rally. So you've had negative divergence there. Well, with the S&P 500 rallying back to the highs here, notice this is going lower. So the divergence is getting more pronounced. So that's another reason to be cautious. Chart 42, here's the NAMO, NASDAQ McClellan Oscillator. Now, Steve has the S&P 500 on here. Probably should have put the Qs, but whatever, they're moved similar. Anyway, very simple thing here. Whenever the NAMO is below zero, you generally don't want to be in the market, or you're trending down. When it's above zero, you're up. So one thing, notice here, NAMO was above zero through late October into late December, then went below zero. And while the S&P's rallied back, this continues going lower. So that is a divergence. This is either going to turn around, or this is finally going to start pulling the market back. So that's a little warning. Chart 43, here's the S&P with the NIMO. Tom McClellan discussed this in late December or January 1st. He had a confirmed sell signal. And what that is whenever price is going higher, the NIMO is diverging. That's not your trigger. Your trigger is when the NIMO, after a divergence, goes below zero, which it did there at the beginning of January. Now the market's rallied back, but this still remains below zero. So, there's a pretty pronounced divergence here that is building. Chart 44, here's both the NAMO and NIMO together. Again, they both look pretty identical. Next, moving on to some bonds. Here's the high yield corporate. So the high yield corporate market tends to follow that, has basically mirrored the market pretty well here. Quite honestly, it was lagging initially, but it's rallied back quite a bit. Chart 47, here's the S&P versus high yield corporate. So again, the two tend to move together. What you want to look for is divergences. When they diverge, tend to occur near major inflection points, like you can see here at the October lows, the July highs. Now, technically, you still have a divergence here. Slight higher high in the S&P, slight lower high in the HYG. Again, this could easily be erased if the high yield corp makes another high here, but it is still technically here. Next, chart 48, here's the 10-year Treasury yield. Remember back in October, I called for a pretty good intermediate top there in rates at 5%. That corresponded with a strong pullback in rates, strong market rally, then the rates rallied. We're pulling back a little bit here. Because we have a symmetry break, I'm looking for a higher low, maybe a wave B, then another move up in C. Maybe that would be a catalyst for the market to pull back if rates rally back up as well. Next, chart 49, here's the 10-year Treasury yield. This is the big picture chart going back to the 80s. Like I said, the secular bear market in interest rates in the 10 and 30 year is over. When we broke through that channel line, that 35-year channel line. So long term, rates are in a secular bull market. Again, they're not going to go straight up. The rates paused here at this 5%, this supply zone. Maybe they do something like I show here, but ultimately form a higher low later in the year, then rally again. Chart 50, here's TLT, 20-year bonds, monthly. This was what I based my call on for rates to have at least put in a bottom there in October, was you had 5 waves to the downside into a demand zone with positive divergence playing out. Now, rates have rallied off the lows. I'm viewing this as some sort of ABC rally that ultimately forms a higher low. But if this is the true pattern, rates should go higher this year over time because this pattern is far complete. We're just in this wave A right now. I hope that makes sense. And chart 51, here's TLT, 20-year bonds. Again, moves opposite of, this is the daily. It's pulled back into this 200-day moving average. It could be an area for this to start trying to bounce again. Chart 52, here's TBT, ultra short bond ETF. This was the way to play the rally in interest rates, and it's moved up nicely from our trigger. Finally, chart 53, here's the yield curve, 10-year divided by the 2-year. We want to keep an eye on this, guys. As you know, it went negative, inverted back in 2022. We had all the recession talk. We have yet to see a recession. That said, this has been working higher. Whenever it goes back above 1 from the inverted area, when it becomes non-inverted, that's typically when you get your recession starting. So that's why we want to keep an eye on this now this year. I wouldn't be surprised if this goes back above 1 sometime earlier this year. And chart 54, another yield curve chart, same thing. Let's move on. Chart 55, looking at a few sectors here. Here's XLK Technology, again, very similar to the Qs. They were the best stronging sector last week. Though, if they make a new high here, you're going to have a much more pronounced MACD divergence. Chart 56, retail. Last week I said this looked like a bear flag setting up, and you can see it's starting to sell off as of Friday. Wouldn't be surprised to see it tag its 50-day moving average over time. Chart 57, XLE Energy. This little bear flag played out. So far, prices filled that gap, open gap. Those are often a magnet, and is trying to bounce here a bit. And that's all the sectors we're going to look at today, guys. Next, chart 58, here's DBC, Commodity ETF Index. Again, it's ultimately been downtrending since the September highs. You know, really no changes here. Still below its 50-day moving average, still below the trend lines. Chart 59, here's a monthly chart. So the bigger picture view of DBC. So DBC Commodities started their bull market move kind of back in 2020 and 2021, 22. So they've been in this consolidation pattern. 3-wave pullback so far. From here, this makes a new low. This could be maybe a 5-wave of a coil. Moving average ribbon is now pinching. So this is an interesting area. If this commodities are going to bottom this year, the moving average ribbon pinching is definitely an area where you would eventually start seeing this probably fairly soon. Something to monitor. Chart 60, crude oil. Again, crude oil's had a heck of a sell-off from that high in September where we call that 5th wave high. Been downtrending, lower highs, lower highs. It was forming a coil last week. Tried to break out of the coil on Friday. Came way off the highs. I have a wave 5 marked here into the demand zone where we rallied. But should we go down and sell off again to another low, then wave 5 would be, down here. So we'll see what this does. We did break symmetry here slightly, so there's still some odds at a higher low here. Chart 61, natural gas. This sector rallied 14% last week, over 6% on Friday alone. Again, strongly influenced by that cold weather. You got to be a weatherman to trade this ETF, but really nice move out of this coil. We were showing this back in December. Nice move. Chart 62, copper. Continues to sell off from that rising wedge pattern that we had in place back in December. This is your long-term support, which rallied off of last year multiple times. Chart 63, DBA, still in this overall bigger triangle-like pattern. No changes. And last week we had a huge move, guys, in uranium. So here's uranium ETF, big old gap up on Friday, up 7%. They had an they had an they issued a dividend, guys. I know some of you are long this. It was a heck of a dividend. Hope you guys caught that. I think it was $1.50 dividend. Very nice dividend, up around 6%. So again, this is a long idea I put out early last week on Monday. Hope you caught it. Uranium, I've been long-term bullish since 2020. So here's the weekly chart. You can see the start of the bull market. We had an initial rally up into 2021, then a big wedge pullback, and then we've rallied now to new highs. Chart number 66. Here's the monthly chart of uranium. Again, this is why I was super bullish on uranium back in 2020. You were coming out of a long-term base. You broke out, moving average ribbon was pinched. You had a good rally up. You were forming a coil last year. Last year, I must have said a dozen times, look for a break of the coil to go long. You did, and it's rallied up nicely out of the coil. Now, where's my target? I think it could make it up to the supply zone, up in the 40s. That's still one hell of a percentage move, one hell of a percentage move from that coil, and of course, from my initial entry down here. Next, chart number 67, UEC. Here's uranium stock that I also showed last week. Huge move on Friday, up 12%. Awesome. Chart number 68, here's CCJ, another uranium stock. Look how much this puppy's rallied since that 2020 area where I called that bull market. Rallied from the 12s up to $50. Chart number 69, DNN, another uranium stock. Breakaway gap there on Friday. So again, if you've been a Breakpoint trade, you know I've been long-term bullish on this sector for the last 3 years. And hope you guys pay attention. Next. Moving on to Bitcoin, chart number 70. Here's Bitcoin. This is the weekly chart. By the way, guys, we drew this chart back in 2022. We showed a fifth wave low. Price rallied. We added the fibs. I said the 61.8 fib was my target. Price hit it exactly. Pulled back. Last week with the SEC news was a perfect buy the rumor, sell the news. Once the news came out, Bitcoin area and the stock sold off. Chart number 71, here's the daily Bitcoin. Again, you had a good MACD divergence, RSI divergence on that rally spike last week, pulling back. This week, price is stable. It's up slightly. Looking at some of the Bitcoin type stocks, here's chart number 72, GBTC, Grayscale, Bitcoin. Now, again, we have new Bitcoin ETFs that are better, but this has had a monster move. Remember, the KISS system went long back there in October. Chart number 73. Now, some of the stocks following Bitcoin were weaker than Bitcoin and selling off prior, and that gave you an early warning. Look at Mara. Sold off. Big initial sell-off. I said look for a lower high. We got a lower high as a wave B. We're now selling off in a wave C. Look at that sell-off. Look at that volume. I think it at least tags its 50-day. I hope none of you got trapped long in this thing. Next. Chart number 74, MSTR, another one. Look at this one. Sell off, didn't even bounce off the 50-day and smashing right through it. Next, chart number 75, US dollar. Here's the dollar. Again, the dollar's rallied off that low, but still struggling up around this resistance area. It did fill that gap, but it's still in a downtrend. Lower highs, lower lows. Moving on to precious metals, chart number 76, gold. Gold rallied last Friday off the highs. Again, so far we still have a series of higher highs in place. You could elect to have a swing stop either maybe at Friday's or Thursday's lows there, 317, or the previous one, your choice. It is still uptrending technically. Chart number 77, here's another daily chart of gold. So what you want to watch is the ratio here. It is starting to curl up. The stocks are leading the gold at least slightly. You want to see more than a couple days here though. So we want to keep an eye on the ratio because the stocks tend to lead. Jabber 78, silver, daily, still overall in this bigger patterns. And chart number 79, the monthly chart of silver. I've been showing this 4-year coil. Again, this has been forming for 4 years. Energy is building. It's going to eventually have a big pop out of here, but it's a monthly chart, guys. I mean, this could stay in here for, months before it breaks out of here, but this is something to watch over time. Once it breaks, I think it's going to have a big move. Moving on to precious metal stocks, here's GDX. Weekly, down 0.25% for the week, so recovered a little bit, but still in the bigger coil overall. Jabber 8081, here's the daily view of GDX. So here we have, this would be the bullish case, kind of a complex inverse head and shoulder pattern here. But again, you need to hold last Thursday's lows. If GDX sells off here and takes this out, this pattern is negated. But you did have a decent risk reward here where you could have a stop right around that 28.50 low. Onus is on the gold bugs now. Jabber 82, here's a 2-hour view. Bounced off this little demand zone. The ratio has been trending up a little bit. And chart number 83, here's the 60-minute chart with the ratio. We've rallied off the demand zone. So we'll see, guys. Onus is on the gold bugs, but, there is a shot here if they can hold that higher low. Finally, going to follow up with some of our other trade ideas. Again, I did not add any new ideas because we'll be leaving. Here's NVIDIA. I put it out last week on Monday. What is this? A nice coil pattern. Excellent trade. Hope you caught it. Chart number 85, Microsoft was another one I put out on Monday. It was a beautiful coil. You could have went long, put a stop right at that, just below the 50-day. Really nice trade. Again, big cap tech is what led last week. Chart number 86, HCAT was a long idea from the previous week and a bull flag. This was my target area, which it hit. So I hope you took your profits. Was a nice trade. Chart number 87, MXCT, another one from last Monday. Continues to work higher out of that wedge pattern. Chart number 88, SMCI, another one that is broke out of that coil. Chart number 89, SARK. This is the inverse Cathy Woods. We put this out as a little hedge on the market, and it did trigger here on Thursday and Friday. Chart number 90, VAC. This never triggered last week. This could be a short if it loses this area. And chart number 91, BDTX. Another idea from last week did not trigger. This is still a very valid long if it can clear this 312 area. All right, guys, that'll do it. Newsletter's been 50 minutes, long enough. Again, appreciate all your support. Tell your friends and family about our KISS systems. I think they're an awesome management tool for folks for their 401ks and stocks. And we appreciate the business. If you do get some of your friends and family to sign up, email into us and I'll give you some comp time. All right, guys, have a wonderful rest of your Sunday. Stay warm. Take care.